So let's get started with the Celsius loan and liquidation process. So Bennett, can you go ahead and get us into that?
Well, sure. Let's start with the most basic parts. Tether was the lead equity investor in Celsius's Series A, and so is a part owner of Celsius. Besides this, we knew from the past and have talked about before on this show how Tether extended secured loans to various other crypto companies, including Celsius. The way these would work appears to be that Celsius, Babel Finance, Nexo, whoever would put up about, say, $1.3 billion worth of Bitcoin, hand it over to Tether, and Tether would then extend them a loan of about 1 billion Tethers at, I think it was like a 6% interest rate or something, is what Mashinsky said the loan from Tether was. And then, that was the loan. What ended up happening is when Celsius was having all of these liquidity issues, they were unable to post additional collateral to Tether, and so Tether, to protect the value of their reserves, which this loan was a part of, supposedly was able to liquidate the collateral above the face value of the loan and still return some of it to Celsius. This liquidation by Tether may have been what ended up putting some of Celsius's other loans and positions into danger. I think it was during the Contagion episode, but it might have been when Dirty Bubble Media was on. We talked about how Tether liquidating this loan to Celsius and selling this $1.3 billion worth of Bitcoin into the market may have been one of the things that was really pushing down the price of Bitcoin during that period where Celsius shut off withdrawals and ended up threatening their MakerDAO position. Because people remembered during that period, Celsius spent a lot of that threat of having their MakerDAO loan liquidated, and that was a wrapped Bitcoin position.
I know we've discussed it before, but can you just go over what MakerDAO is so that everybody is caught up here?
Sure. MakerDAO is a stablecoin that's basically based entirely around the idea of these same kind of secured loans that Tether is giving people. You over-collateralize a position with cryptocurrency. So in Celsius's case, they were using wrapped Bitcoin here, and so they put up about the same as what Tether required, about 30% over. And then you get extended a loan in DAI, which is a stablecoin effectively collateralized by these loans, and then you can use that as a stablecoin. Often it's used to effectively lever up in the cryptocurrency ecosystem, right? You take the crypto you own, you put it up as collateral so you can keep your exposure to that. You get this new stablecoin, in this case basically the same, whether it's Tether or DAI. You use that to purchase more crypto or to do other crypto trading and things like that, and in doing so effectively increase your exposure as a whole by increasing the leverage in the system. So Tether supposedly liquidated their loan, and Celsius got in trouble because of it.
Well, I think when most people consider loans, now there's the obvious ones that probably everyone is familiar with is a mortgage, which are generally over-collateralized. So you'll put down however much the home is worth. Let's say the home is worth $1 million. You would put down 10, 20%, something like that. And then the bank would extend the rest of the value of that home to you, with the understanding being that you're going to make payments on that for the remainder of it could be 15 years, 30 years, who knows. You're going to pay that out. And if you stop paying, they're going to take your house from you. And so now they have over-collateralized that loan. But normally, loans are not necessarily over-collateralized. If we're talking about business loans, if we're talking about personal loans, if we're talking about a lot of different loans, they're not actually over-collateralized. They're collateralized to some degree, right? When I think of most loans, either it's unsecured or the individual genuinely does not have the capital necessary to over-collateralize a loan. So when you're talking to me about all of this over-collateralization, the only other example in my head where over-collateralization is the norm, which is like margin trading, leverage trading, options trading, that kind of thing. It's like, these are prime examples of when you need to be over-collateralized because the broker might need to call it in and take everything. And so it sounds to me like you're suggesting that's what this over-collateralization is all about. It's all about levering up.
Yes. So I think you made a couple of points there that I'm going to dissect a little bit. Like a revolving line of credit extended to a business is not necessarily collateralized, but in many cases will be by, for example, partial ownership, some amount of equity in that business itself. And we're saying over-collateralized, but we really shouldn't be. And we talked about this back when Francis Coppola was on, back at like episode 20. The Bank of International Settlements basically says that cryptocurrency is too volatile to be used as loan collateral because you can't be confident that you're going to be able to liquidate it, right? And like we've seen with a whole bunch of these loan platforms that were exposed to 3 Hours Capital and all these other ones, that many of them, despite the loan initially appearing adequately collateralized, when they went to liquidate, there was not adequate liquidity for that loan to actually be adequately collateralized. That even appears to be what's going on with the CoinFlex Roger Ver dispute, right? Is that when they finally liquidated the collateral in his futures account, they ended up with a deficit because they had extended too much to him effectively. And so we're saying over collateralized, but these are not really over collateralized. They're collateralized, hopefully. The Bank of International Settlements would say no, but we'll say they are for this. And the issue with crypto collateralized loans, like we kind of talked about in our contagion issue, is what you're leading into now, is that it is generally used as a way of levering up. It's trying to maintain exposure to your crypto asset and still get an asset you can use to continue to trade, interact, and increase your exposure to the crypto ecosystem. And I think the other example that we do commonly see that looks kind of similar to this is borrowing against your stocks, right? Like we've seen a lot of Elon Musk, for example, put up a bunch of Tesla stock as collateral, have a bank extend him a loan, and then that is kind of vaguely similar to what we see a lot of these cryptocurrency places doing.
On that note, I'm going to go ahead and jump into the actual. So Tether released a statement on July 8th, and I'm not going to read the whole thing, but I am going to read a part of it. We'll link to it in case you want to feel the full wrath of Tether. And there's a couple weird things in this statement to me. But first, the Tether loan that was taken out by Celsius was an over-collateralized loan denominated in Bitcoin at 130+%. And the decision to liquidate the collateral to cover the loan was a part of the original terms of the agreement between the two entities and reconfirmed in writing before the start of the liquidation event. This process was carried out in a way to minimize as much possible any impact on the markets, and in fact, once the loan was covered, Tether returned the remaining part to Celsius as per its agreement. Okay, if I have taken out a short position or a margin loan to buy stock and the bank margin calls me, they take it. They don't send anything back. They take my collateral. That loan is done, and I've been liquidated. Never will the brokerage send me anything back. Help me understand why they're sending capital back after they've liquidated a company.
I mean, presumably because it's part of the written agreement they have with Celsius, right? Is that after the liquidation, since presumably like their maximum loan to value ratio is at a point well above 1-to-1, they probably include in the agreement that when the liquidation is completed, Tether will send the remainder to Celsius. I don't think that part's particularly unbelievable here. But there's a more troubling aspect to this loan that I think we need to touch on here. And this kind of goes back to Tether was one of the lead investors in Celsius. Tether owns a portion of Celsius. Celsius used customer deposits, these Bitcoin, to get this loan extended in Tether. And when the time came, Tether sold customer deposits from a company they own a part of into the market and just liquidated them, protecting Tether's reserves, but selling the customer deposits of a company that Tether partially owns. That is a morally challenging position to be in. And I think that's a detail that hasn't gotten as much attention yet in this story, is that like the fact that Tether extended the loan in the first place and was willing to basically take these customer deposits from Celsius and do this and give them this loan that they knew could be liquidated itself has problems. But then that they actually did liquidate it and sell these customer Bitcoins that had been extended to them by Celsius feels real bad.
Morally, that's pretty ambiguous, but I would say from a business perspective, I am like, okay, well, obviously they're going to do that.
Before we move on from this, I do have a couple of other thoughts on this loan. Before this episode comes out, another episode we recorded just a couple days ago will be out, in which we discuss a lawsuit filed by Jason Stone against Celsius. In it, he alleges the original loan from Tether to Celsius was effectively a bailout for Celsius because they had ended up insolvent by not appropriately accounting for user funds and using user funds to trade. This is not the only time Tether has been accused of doing this. In December of 2020, Decrypt ran an article discussing a whistleblower allegation about Babel Finance, another crypto lending platform at the time that was really popular in China. This platform had supposedly taken customer deposits, had begun trying to lever up using them to trade and pay out higher yields. When they ended up in a position with inadequate liquidity, Tether stepped in, bailed them out, and kept them going. And I think this kind of points to something we've discussed for years at this point, which is that Tether is not just a dollar peg token. Tether is not just its market cap. Tether is like this integral and insidious part of the crypto industry that gets in and is connected to so many other pieces.